others to join. Okay, I'm here. Okay, we can start now. Since they are not, because I said 15 minutes grace, and yet they've not joined. Okay, good evening. I mean, good morning, everyone. We're having chapter 7, according to the information. I said I need to take chapter 7, which is audit planning. Now, audit planning is one of the first steps that needs to be carried out in an audit engagement, okay? To determine how successful the audit engagement will be, it depends on how the audit planning has been developed or has been executed or implemented. Okay, so audit planning is very, very essential, and we are going to look at audit planning from the perspective of audit engagement. Okay, so the first thing we need to know is that there are relevant international standard auditing that relates to audit planning. One of them is ISA 200. ISA 200 centers around overall objective of an independent auditor and the conduct of an audit engagement in accordance with international standard on auditing. So what this one is saying here is that it's essentially talking about how to carry out an audit engagement in accordance with what? The ISA, International Standard on Auditing. Okay? Now, the objective of the auditor as per ISA 200 are, number one, to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. But what this means is this allows the auditor to give an opinion on whether the financial statement are prepared in accordance with applicable financial reporting framework. You know, I've always told us that the main essence of preparing audit reports is to ensure, or the main essence of carrying out an audit engagement is to ensure that the financial statements are prepared in line with applicable financial regulatory framework. So if it's done in that order, then there will not be any material misstatement detected in the course of the audit engagement. Okay. Now, mind you, we need to talk about, I think we'll talk about it much later in this chapter. There's a difference between misstatement and material misstatement. Okay. When we talk about misstatement could be as little as, let's say, you wanted to write 5,000 or 50,000 and 55 naira, 55 kobo. And you wrote 50,000, 55 naira, and you ignored the 55 kobo. That is misstatement. And that is acceptable. That is allowable. Okay. But when you have misstatement that is gross, that is fundamental, then you can term that one as what? Fundamental misstatement. What do you mean by fundamental misstatement? According to ISA 450, okay, material misstatement relates to one, wrong application of the accounting standards. When you misapply the accounting standard, for instance, you know that the golden principle is that for every debit entry, there must be a corresponding credit entry, which implies that for all expenses have debit balance, all income have credit balance, assets have debit balance, okay? Liabilities have credit balance. Now, when you now post your liabilities to having debit balance, that means that you have negated the fundamental principle of accounting. So that would be taken as what? A material misstatement. So like I said, there's a difference between misstatement and material misstatement. Material misstatement is not condoned, it's not allowable. We cannot tolerate it at all. Okay. Another one that can categorize as misstatement in line with ISC 450 is when you talk about inappropriate disclosure in the notes to the account. Okay, the account is not presented in the format that is supposed to have been presented as described in ISA 1, which is being replaced with IFRS 18 now. So if you don't present your financial statement in that template, that format, then it is a material misstatement. And also where information useful information, fundamental information are not provided that will aid the understanding of the financial statement prepared, when this information is absent, can be seen as what? A material misstatement. Okay? So I'm coming. I'll get back to you shortly. Okay? Just Okay. I hope we are all here now. We have 9 people already now. I'm going to recap on what I said. I said that audit planning is very essential in any audit engagement. And for this topic, we'll be looking at relevant international standard auditing, which is ISA 200 and ISA 300 respectively. ISA 200 talks about overall objective of the independent auditor and the conduct of an audit in accordance with international standard on auditing. So what you need to bear in mind is that we talk about audit engagement. The main importance or the main essence of audit engagement is to ensure that the financial statements are prepared in line with applicable financial regulatory framework. It's very, very essential. That's the main reason. Not even to give opinion, but to ensure that financial statements are prepared in line with applicable financial regulatory framework. Then secondly, we need to be sure that there are no material misstatements. And I try to explain the difference between material misstatement and misstatements. Okay? Then another thing we also need to understand is that where the auditor is not able to obtain sufficient and appropriate audit evidence, right? It is going to lead to what? Qualification of audit report. And I believe that we have done reasons for qualification of audit reports. I will not need to overflow that matter in this chapter. Okay. Now, other things you need to know about this ISA 200 is that it requires the auditor to comply with all relevant international standard on auditing that is relevant or peculiar to that engagement. Okay. What that means is that it's not all the international standard auditing that will be required in every engagement. For instance, group audit, ISA 600 will not be required in an engagement where you don't have a group structure. That's what I'm trying to say. Okay, that's what I mean by ISA. That's what I mean by relevant ISA to the audit. Then he also expects that the auditor complies with relevant ethical requirements. All ethical requirements that we talk about in chapter 3, professional conduct, objectivity, integrity, confidentiality, all those things. We need to also ensure that they are in good, appropriate position. Number 3, the auditor must plan and perform the audit with professional skepticism. We have talked about professional skepticism also. We talk about professional skepticism, you are saying that as an auditor, you must have a questioning mind. You shouldn't believe all what that is presented to you as audit evidence. You should be able to what, critique your audit evidence, okay, to be sure that what you requested for or what you needed is what is presented to you. That what we mean by what professional skepticism. Also, the auditor needs to exercise professional judgment in planning and performing the audit engagement. What that means is that as an auditor, based on your previous work experience, audit experience, you're able to utilize what we call professional judgment. Based on your, how do you get professional judgment? Based on your previous or past experience, audit experience, you'll be able to juxtapose your experience with every engagement that you are about to embark upon. All right. And it's also essential that the auditor obtains sufficient and appropriate audit evidence, because without the obtaining sufficient and appropriate audit evidence, then the audit report might be what? Might be qualified due to what? Limitation of what? Scope. Okay? Where adequate information is not provided or is not presented, it will lead to what? Limitation of scope. So the auditor will need to do what? Qualify the audit opinion. Okay? And if he's able to obtain sufficient audit evidence, he's going to assure or give what we call reasonable level of what? Assurance that we talk about in what? In chapter 1. That is, he can go to any length to defend the audit report, knowing fully well that he has all the necessary, all material, all information in the material respect, okay? All information needed at that particular point in time, to be able to defend to any length how the audit has been what has been conducted. So these are the relevant requirements of the auditor in line with ISA 200. Okay. Is there any question, any comment before we proceed? Does anybody have any question, comment on these ones that we talked about before we proceed? If there are no questions, we proceed to the next one. Then the next thing we need to do is that in the course of planning your audit engagement, there's a need for the auditor to come up with what we call audit planning memorandum. Audit planning memorandum, or you call it audit strategy memorandum. Okay, audit planning memorandum, you call it what? Audit strategy memorandum. Now, this document, what it does is that it provides like a guideline. It provides what? Guidelines on how the audit should go. That at any point in time, they can track to see that all necessary areas that need to have been touched and what has been performed, so that they will not miss out any vital or any important aspect of the engagement. That's where you come up with what we call the audit planning memorandum. You need to note also that the audit planning memorandum, embedded in it, you have the audit plan, okay? You have the audit programs, okay? And you have the audit checklist. Embedded in the audit planning memorandum, we have the what? Audit plan, audit programs, and what? Audit checklist. So all of these are embedded in what we call the audit planning memorandum. The audit planning memorandum is a document that contains all the planning decisions about the audit engagement. I take it again. Audit planning memorandum is an audit document that contains all the what? Planning decisions about the audit engagement. Okay? That is what you need to know. Now, in your audit plan, right? In your audit planning, there are 3 areas you need to focus on. Number one, you need to look at the audit risk. You need to look at materiality, and you also need to look at the use that you might make out of what? Having a client in a computer-based environment. That is, where you have a client that operates in a computer-based environment, the planning, audit planning will be different from where the client environment is operated in a manual format, that is, there's no system. So these are the three areas the auditor will focus on in the planning for the audit engagement. Okay. Now, I talked about ISA 300. Now, ISA 300 is all about, ISA 300 is all about, don't want to drop anything there, you know. It's all about planning the audit of financial statements, okay? So what this means is that for you to carry out an effective audit, you must ensure that the audit is performed in an efficient and effective manner. Okay, the audit is performed in an efficient and effective manner. Also, you need to also understand that in the course of planning for the audit should be planned in such a way that is performed effectively. Okay, and the audit plan should entail measures for the direction, supervision, and review of the audit work. That is only we can checkmate to see that you have not left out any aspect of the audit engagement. Where you have supervision, where you have review, where you have direction, it will be impossible to gloss over important areas in the course of the audit engagement. Okay. Now, I've talked about the audit strategy memorandum. I've talked about what it means. So this document, like I said, contains all the prime decisions in the what? In the audit engagement. So these are some of the information that are contained in the audit planning memorandum. Content of the audit planning memorandum are this. Number one, it contains the assignment, objective, and report to be issued. That is the scope of the audit, okay, the objective of the audit, and the report of the audit is contained in the audit planning memorandum. Number two, the audit timetable, okay, how they are going to plan the work, that they will be able to cover all the areas within the stipulated period of time. It's also contained in this audit strategy memorandum. Number three, in the audit planning memorandum, we also have, if there are many changes in the organization since the last audit, for instance, if as at the last audit, you have the new CFO has just joined after the last audit. So the auditor will send this information to you, this form to you, to fill it, to populate it, that if there's any changes, let's say there's a change in the company's policy, organogram, or procedure, all of this will be contained in this area, this aspect, changes in the client's organization or business, external environment and the like. External environment are those things that you know, those things that are outside the control of the client. Your PESTE in your CSME, okay? PESTE, political, economic, social, cultural, technological, environment, and legal environment, all of those things, okay? These are outside the control of the organization. So where there are changes in these areas, it can affect or it can impact negatively on the environment, okay? And that you also need to look, that also contained in this audit memorandum, is the summary of key financial ratio. Okay, every sector has key performance ratio to drive whether or to check whether the organization is performing or underperforming, whether the organization is growing or the company is what? Is retrogressing. Okay, so there are key financial indicators. I also believe that you've done much about financial ratio analysis, okay, and interpretation. You know that they are pointers, they are indicators to showing whether the company is performing or the company is not performing, okay? Then also, in this audit plan memorandum, you have, sorry, you also have what we call the planning decisions for the audit, okay? I've talked about that. So what that means is that how did they arrive at the approach that they are going to utilize? Remember that you have four different audit approaches. You have the state of financial position audit approach, you have the substantive testing audit approach, you have the business risk and risk-based audit approach, okay? You have all these things, okay? All of these approaches, they are decided on before the audit commences. So that when they start, they say, okay, let's use let's use this approach. No, before the commencement, they will have decided on the approach that best suits the what? The organization. All right. Then also in the audit plan memorandum, we also have information that relates to what are they going to, what is the importance or the presence of the internal audit department. Is that department effective? Is it contributing anything to the engagement? Okay, so they are going to carry out an evaluation of the entire department, whether they are going to rely on any report or information obtained from that department. That is, if that department is effective. All right. Then also they are going to talk about whether they are going to make use of what? Experts. Okay, who are experts? Experts, according to audit, are companies or people that have competence in other field outside accounting and audit. Okay, we have that area as well. Another area that you also need to look at is the staff requirement for the audit. How many staff would you need for that engagement? Are you using 5? Are you using 10? Depending on the size of the organization. Remember, before you draw up your audit plan, you must have carried out what we call a preliminary audit risk assessment to be able to have an overview, okay, of the client environment, to get an understanding of the client environment and be able to plan accordingly. All right. Then another thing that's also contained in the audit planning memorandum is the attendance location. Okay. How can you know how many locations that exist in your client business? Is when you carry out a preliminary audit risk assessment, you're able to determine how many branches they have. And you're able to determine if there's a need to visit all the branches or to obtain a report from those branches not visited by the auditor. All right. They also need to determine the method of communication. Are you using WhatsApp? Will you be using emails? Will it be through phone calls? Okay. The medium of communication must be established before the audit commences. All right. So those are the things that I think are some of the things that are contained in the audit planning memorandum. Like I said, this list is not exhaustive. Okay, there could be more. Okay, but for your exam, if the question should come out from this area, they rather ask you to list like 5 or 6. What you have here is more than 10. All right. So if you have more, you can add to it. Now, once you also need to understand that in the course of planning the audit engagement, the auditor is going to gather both all information, relevant or irrelevant, okay, for that particular engagement. Because at the time of obtaining the evidence, there are some that will not be relevant for that particular audit. Those ones will be utilized during other audit engagements, okay, like other audit-related services, like review, like your compilation report, like your um, agreed upon procedures. All of these things will be a factor. Okay, so that's what you need to know. All right. Any question? Any comments? Okay. If there are no questions, we'll go to the next one. You know, I said that in your course of planning your audit, you look at 3 areas: audit risk, you look at audit risk, you look at materiality, you look at the use to be made of computers. Okay, those are the 3 areas. Let's start with the first one: audit risk. What is audit risk? Audit risk is the risk that the auditor will give an inappropriate audit opinion. Okay, audit risk is the risk that the auditor will give what? An inappropriate audit opinion. That is, there's every likelihood that whenever the auditor issues the audit opinion, there are chances that the audit opinion provided by the auditor or issued by the auditor or given by the auditor might be incorrect due to certain factors. Okay, that's what we mean by audit risk. Okay, and there are 3 components of audit risk. There are 3 components of audit risk. We have the inherent risk, you have the control risk, and you have the detection risk. Those are the components that make up the audit risk. But at all times, it's essential that the auditor should ensure that the audit risk is brought to an acceptably low level. It's brought to what? An acceptably low level. Okay? Let's look at the risk one after the other. What are inherent risks? What are inherent risks? What are inherent risks? Inherent risks are risks that by their nature, okay, are transactions, account balances by their nature, they are susceptible to what? Manipulation. They are what? Susceptible to what? Manipulation. What are examples? I made mention of account balances, transactions. Let's look at account balances. Your non-current asset is susceptible to what? Manipulation. How? Where they refuse to carry out impairment test on the non-current assets. That means the value that they have reported in financial statement might be what? Overvalued or what? Undervalued. Okay? Your inventory too. There are approved or recognized costing method. Okay? The recognized costing method are the first in, first out, and weighted average. Where they use last in, first out or standard costing, that means they have not reported the inventory in the appropriate costing method. So that means whatever the value of the inventory will be susceptible to what? Manipulation. I hope you understand. That is inherent risk. I say by the nature. Then control risk. Control risk are risks that the internal control system put in place will not detect the risk. There are risks that the internal control system put in place will not be able to detect it. That is, the internal control system will fail to detect this risk. We call it what? Control risk. What do we mean by that? Let me give an instance. The accounting policy says that any transaction above 1 million naira, they should be at any procurement above 1 million naira, they should attach a local purchase order to it. But upon the review by the auditor, external auditor, of all the procurement, they found out that there are no LPO attached to transactions above 1 million naira. And some of the samples that were collected, they are over 50% that don't have the local purchase order attached to them. What does that mean? That they are able to put control in place, but that control is not achieving the needed objective. So that is a control risk. All right. Then we have what we call the detection risk. Detection risk is a risk that is peculiar to the auditor. The other two, they are out of the control of the auditor. But this particular one is within the control of the auditor, detection risk. These are risks that the auditor's test and procedure will fail to achieve the needed audit objective. The needed audit procedure, audit test will fail to achieve the what? Audit objective. We call it what? Detection risk. Okay? So the auditor decides to carry out audit test to ensure whether to confirm or to evaluate the internal control system. And at the end of the day, he said the internal control system is strong, whereas the internal control system is weak. Okay? If such should occur, what implies is that the auditor is not knowledgeable about the client business. So that means whatever the procedure he has performed, whatever the audit test he has performed, would have failed to achieve the audit objective. We call it what? A detection risk. All right? So now what you need to know is that the ability of the auditor, okay, to be able to balance these three risks in order to achieve an acceptably low level of audit risk is what we need to what? Audit risk model. What does that mean? As an auditor, there's a need for you to be able to balance these three components of audit risk: inherent risk, control risk, and detection risk. The ability of the auditor to balance these three components of audit risk will give rise to what we call audit risk at its what? At its barest minimum. That is, the audit risk will be at the acceptably low level. Okay? So that's what that is for that. All of what you have here is what I just explained. That's why you see that I didn't talk about. You can see all of them, they are there. I just explained them one after the other. Okay? So this is it. So this is what we are saying. For you to achieve your acceptable low level, look at it here. Inherent risk and control risk, when they go together in the same direction, if inherent risk is high, control risk will also be high. Okay? But when detection risk is low, inherent and control risk will be what? Will be high. They go in inverse direction. Okay? But at all times, the three should be managed so that to achieve acceptably low level. Okay? So that is that. That's the description you have there. All right. Mm. All of this is talking about that same. So let's look at this next one. Relationship between business risk and financial statement risk. Okay. What is business risk? Business risks are risks that affect the achievement of the business objective. Business risks are risks that affect the achievement of what? The business objective. So, what are some of those risks? Some of the business risks that we have, okay, we have two of them. We have the internal business risks and we have the external business risks. Internal business risks are what the company or the business are within the control of the business. For instance, high iteration rate or high labor turnover. Okay, when your staff move or they migrate or they exit the business as soon as they join, it shows that there's something that is amiss with the policy of the organization. It could be anti-human. So that's why most of them, once they just come, they just what? They move ahead. Because of what? They are working in a toxic environment. It's not government that will be able to put that into check or control. It is the management that will see to this, to resolving this matter. Those are the internal business risks. Okay? External business risks are the ones that are outside the control of the business. For instance, exchange rate that we are talking about now. They are outside the control of the business. Okay? There's nothing company can do. You cannot figure out ways to manage the complexity in the forex fluctuation. Then such business is at the mercy of the what? Of the economy. Very soon they will shut down. You can see that most companies, national companies, are leaving Nigeria for other countries because of these issues and other issues as well. Okay. Now, what's the relationship between your business risk and your financial statement risk? First of all, what is next thing? What is financial statement risk? Financial statement risk are risks that the financial statement could have been what? Materially misstated. Financial statement risk is the risk that financial statement could have been what? Materially misstated. That is, there are possibility that there are misstated balances in the financial statement. So how do you marry the two? Now, remember that organizations, their main aim is to make profit, especially businesses. They are established to want to make profit. So what they do is that when they are faced with some of these challenges, what they do first of all is to look at how they can manage this risk in their businesses. And what that means is that in a way, they are going to structure their financial reporting to accommodate this business risk. Okay? They will structure the financial statements in such a way to do what? Accommodate what? This business risk. Now, let me give an instance. Now, let's say we have a company that is affected by government policies. Let's say a company that is into the production of manufacturing. Okay, they are manufacturing, they are into the production of, let's say, what can we use now to buttress this thing? Okay, let's say soft drinks. Okay, now you know that over time, government has imposed tariff, okay, to reduce the consumption of sugar. What that implies is that when importers they import sugar, okay, they put high tariff on sugar importation. Why? Because they believe that when these citizens or the populace they take too much sugar, it leads to increase in what? Diabetics. So as a way to discourage the consumption, what would they do? They would do what? They would increase the tariff. But some of these companies that are manufacturers of beverages like bottling companies, 7-Up, Coca-Cola, and the likes, they'll still make use of sugar one way or the other. All right. Now, if they now say that, okay, they've banned sugar or the tax or the tariff on sugar is high, they want to augment it. Okay. Now, what would they do? They can use other alternatives to sugar, like polysaccharin, or they use dates, or they use honey. Any of these, they are called sweeteners, right? Now, if such, in order for them to be able to manage the tariff or the penalties they are going to pay, or to find a way to manage their profitability as a business, what would they do? There's a way they are going to uh, work or prepare the financial statement such that they will underreport, okay? They will underreport their what? Their profitability, because they know that if they report high profitability, there's every evidence that the regulators, okay, will come after them to say that I thought you are not, I thought we said if you are using sugar, your profitability should not be this high. So what has happened? You understand what I'm saying? So by the time they find their returns for the year, you're able to determine whether anything is right or wrong with the financial statement. Okay. So what that implies is that if you have an auditor, external auditor, that does not have this understanding in the course of performing the audit engagement of this manufacturing business or outfit, you will not be able to see the details or the devils in the details as per the financial reporting. So it's going to assume that everything is what is fine. And that would have led to him giving an audit opinion that is full of what? Material misstatement. And that will lead to what we call audit risk, which is the risk director will issue an inappropriate audit opinion. So what I'm saying is this: there's a relationship between business risk, financial statement risk, and audit risk. Okay, there's a relationship between the three of them. All right, so that is what we are saying here. Look at the examples they have here. For your financial statement risk, the risk of understatement of bad debt, like for the banks now, most of the loans they give out turns out to be what? To be lost. Okay, and they need to what? Write it off in their what? Against their profitability. Okay, so what will they do? They underreport the what? The bad debt. Overstating the value of inventory. Okay, they overstate the value of inventory so that they will underreport their what? Their profitability. Overstating the value of non-current assets because they did not do what? They did not carry out a impairment test. All of these are examples of what? Financial statement risk. Okay, and for the audit risk, like I said, look at them here: inherent risk, okay, control risk, and detection risk, which I've already discussed earlier. So what I'm trying to say is that there's a relationship between the business risk, financial statement risk, and audit risk. Okay, so that is what we need to understand as far this aspect. Does anybody have any question? Because all of this is bulky. If I'm reading it in verbatim, it's going to be very, very boring. And that's why I decided to look at, summarize it and try to use examples that we can relate with. Okay? I hope we are all good. If you have any question, please feel free to ask your question. Okay? Are there questions? There are no questions. We go to the next area. The next aspect is talking about what? Materiality. Materiality is covered under ISA 320. Okay? Materiality is covered under what? ISA 320. Or better still, we call it audit materiality. Okay? Audit materiality is covered under ISA 320. What does it mean? Now, in the course of planning your audit engagement as an auditor, there's a need for you to factor in your materiality level, okay, or materiality threshold. What is that? Let's look at it. According to ISA 320, materiality is the omission or misstatement, okay, that will affect the economic decisions of the users of the financial information. The omission of an information or misstatement that could influence the economic decisions of the users of the financial information. That is materiality. What does that mean? That is, if an information is omitted or the information is misstated, it has an impact on the decisions that will be taken by the stakeholders or the intended users of the financial statement or financial information. Okay? So let's take, for instance, let's take a look at Heritage Bank that had issues and their license was suspended some months back. Now, let's say that there was an information, a vital information that was omitted from the audited report because the report was presented, the financial statement or the audit report, audit account and report was presented to CBN before the suspension or the withdrawal of their banking license. And let's say that in that, and let's assume that in that audit report, there were vital information that were omitted from the audited financial statements. And the intended users or the shareholders now say that, oh, I think it's high time I bought more of the shares of this bank, where I can see the prospect here, not knowing that there was a vital information that has been omitted or the information has been misstated. Wait for the person to subscribe for more shares. In a few weeks' time, the license was drawn or withheld. What did you happen to that person? The person will nearly die or will run mad. Do you understand? That's what we mean by materiality in audit. That's the impact of materiality in audit. That's when an information that is so vital is omitted, or that information that is so vital is misstated, affecting the economic decisions of the user's financial information. It is what we call materiality. I hope that is clear. Okay. Now let's go on. Now, with that being said, let's narrow it down to the audit engagement itself. At the planning stage, the auditor will need to review the, what do we call, the materiality. And what you need to notice that both planning and materiality, they do not stop. You keep changing your plan, you keep changing your materiality until after the engagement is completed. There's not saying that, oh, my materiality threshold is fixed. There's nothing like fixed materiality. There's nothing like fixed audit plan. It can change. And it is allowed to change until the completion of the audit engagement. So you need to note that. Okay. So I was saying that in the course of planning the audit engagement, you plan your materiality. What do we mean? You want to ensure that there are no material misstatements contained in financial statements. That's why you carry out what we call materiality threshold or materiality level. The auditor will set the materiality level. And what you need to note is that materiality level in audit firm, they are rule of the thumb. Okay? They are what? They are rule of the thumb. What does that mean? That is, these are practices that have been used over time and has become what? Acceptable. Practices or procedures that have been in use over time and has become what? Acceptable. We call it what? Rule of the thumb. All right? Now, also need to understand, because I said this will use over time. That means what you have in audit firm A as materiality level might be different from what you have in audit firm B. It will not be the same. It's relative. But all of them or both of them is to achieve the same or common purpose, to ensure that there are no what material misstatements in the financial statement. Okay, thank you. So materiality threshold, like I said, threshold that are set to ensure that there are no material misstatements in the financial statement. Okay, so we have the rule of, like I said, is a rule of thumb. So the materiality threshold is set using either of these parameters. Either you use revenue, profit before tax, or total assets. You use what? Revenue, profit before tax, or your what? Your total assets. You cannot use the three. You use one of them. If you're using revenue, you stick to revenue. If you're using profit before tax, you use your profit before tax. If you are using your total asset, you use your total asset. Okay, for your revenue is 1% to 2%. What does that mean? Let me explain. So revenue is also subjective. Okay, so some companies, 1 million naira is their revenue and it's a big deal. And some company, 10 billion naira is their revenue. So you can see that it is relative. So it's based on the balances or the total revenue that you use to compute your what? Your materiality threshold or materiality level. Okay. So for those organizations that are big in the sense that they are publicly listed, they always ensure that they are conservative in their approach to auditing. Okay. What does that mean? So to be able to be on the safe side, to be conservative as an organization, they will stick to the 1%. 1% here means that, let me give an instance. Let's use two individuals. One has uh, income, annual income 1 million naira. Another one has annual income 100,000 naira. Okay? 1% of the one for 1 million naira, 1% should be around 10,000, right? Why 1% of the 1,000 should be around 100 naira? You understand what I'm saying? So what we are saying here is that the one that is 1 million, 10 million naira, or 1 million naira, the one that is 1 million naira, right? The one that is 1 million naira could be in such a way for me, could be in such a way that he doesn't want people to know that he has so much money. Do you understand? So he's not going to front that he has so much money. It will be what? It will be conservative in his spending. But the one that has 100,000 naira, you want to feel that he has more money than the one that has 10,000 naira. As what is happening in our society today, most of all the people that you see that front cash, go and check them. Most of them don't have money as much as Dangote or Dangote set or $10 set. But the way they front the money, you see that they are well without. Okay? Why do you think Dangote and $10 don't like to front their money? Because if they front their money, two things can either happen. Then the tax authorities will come more for them to tax them, or more people, the risk it poses to their family and their business as a whole. But you see someone that doesn't have so much money, we find that he has more than enough. Then when push comes to shove, you know, say that all what I was doing is just for clout. That's what I'm just trying to explain. So for the companies that are big, they will use 1%. 1% of 1 million naira is what? 10,000 naira. Okay? The 1% of 100,000 naira is 100 naira. So what that means is that for the companies that are making 1 million naira, any amount, any transaction, any account balances that is 10,000 naira and below to such organization that earns 1 million naira annually, it is what? Immaterial. They will not bother themselves about it because they believe that fraud will not affect their business. But what they also do, aside from doing that, is that they also try to understand that there could be a ploy by the staff within the organization to perpetrate fraud and to do what? To break that money into smaller amounts that will not be obvious to the management or to the auditor. So the auditor will still go ahead to still look at what? Accumulation of similar balances or transactions with similar narration and add them together. If you sum up to 1 million naira or sum up to above 10,000 naira, it could be an indicator of what? Fraud. So you don't just look at it from two angles, looking at a whole sum of what? 10,000 naira in the course of what? The audit, or looking at the aggregation of similar transactions that sum up to 10,000 naira and beyond. Do you understand? That's what we are trying to say. So anything that is below 10,000 naira, it is considered immaterial. The auditor will not focus on. That's why you see that most of the auditors come to your organization. There are some transactions they don't bother themselves with, but because they see it as what? Inconsequential to the engagement, to the audit engagement. Okay? Now, before the auditor set out to carry out this audit engagement, at his firm, he will have been given some information. That is, when you get to this client, you need to be sure that there are no material misstatements in the financial statement. And you are using revenue as a guide, you must obtain sample, that is from the revenue or sales ledger. Obtain samples of what? Like 20 to explain that or to justify that there are no material. That means you have to take samples of the revenue ledger, okay, from your client's ERP and test them, all those transactions, all the sales. Take a sample of like 20, okay? Once you take 20 samples, if you're able to get 20 samples, then that means that there are no material misstatements. And there are times that you have planned to do 20, you get to the client's business environment, you ask for the accounting package or the ERP they are using, you're not able to get up to that 20 samples. But the standard is that they must get like 20, okay, in that kind of scenario. When you get there, you only get like 10 or 7. What will the auditor do in that instance? He's going to go back and say that he has done the needful? No. What will the auditor do? The auditor will now reduce, use his own discretion to reduce the threshold that has been set, because the threshold that has been set before leaving the audit firm is 1%. So you cannot change it to 0.1%, because 0.1% is not the same thing as 1%. So you change it to 0.1%. So rather than for you to be looking for 10,000, you look for 1,000. So he now decided to do 1,000. He now saw like 30 of that 1,000 samples. He could obtain samples of that 1,000 in 30 places, as against the one for 10,000 that couldn't get up to 7. So when he reduces the materiality threshold, okay, in order to be able to give an assurance or to obtain assurance that there are no material misstatements in financial statements, it is what is known as what? Performance materiality. It's what is known as what? Performance materiality. Okay? If that one is not clear, let me use another example for us, a practical one, so that you understand it better. Now, if you want to, if you want to, uh, if you want to cook rice, okay? You want to cook rice. Should I use rice? Okay, let me use rice. If you want to cook rice, right? When you parboil your rice, there is a sieve that you can use to drain the water so that you don't end up taking so much starch. You drain the water, okay? And it depends on the sieve. Now, if you're going to use the sieve that you use for your pap, the sieve that you use to make pap, that one is just like tiny, tiny spores in that cloth, that chiffon material. If they use chiffon material for that, okay? You see that by the time you pour your rice inside that place, it will take a longer time before the water will get drained out. Why? Because the rice seeds or seedlings, they are very big. But until you squeeze the rice, and by the time you squeeze the rice, you'll have squeezed out other important nutrients of that rice. That's what I'm saying. That's why you have a sieve for rice, you have a sieve for pap. Okay? So you shouldn't use you should at all times you use the appropriate sieve for a particular situation. That's what I'm trying to say. So when you see the auditor reducing the established maturity threshold of 1% to now reducing it from 1% to 0.1%, in order to be able to confirm that there are no material misstatements in the financial statement being audited. That is what is known as what? Performance materiality. Okay? So we know as what? Performance materiality. Hope you get it. So there are two types of materiality. You have ordinary materiality or call it materiality level, and you have performance materiality. And I hope that you'll be able to understand the difference between the both of them. Okay. What you also need to note here is that in using audit materiality, okay, there are other factors that the materiality will not reveal. Okay, the other factors that the materiality will not what? Will not reveal. Number one, the nature of the item involved. The nature of the item involved. Okay, what does that mean? That is, if you look at the valuation of some items in the financial statement, they are more subjective than others. For instance, land is subjective. Plant and machinery, or plant and equipment, property, plant and equipment is also what? Subjective. Okay, so if care is not taken, you will see that the majority will not achieve the objective in this regard because of what? The subjectivity that is involved. Another thing you also need to note is that the significance of the item. Okay, some items are not significant in terms of monetary value. Okay, but there are particular interests about them in the financial statement. A popular example of this, you see, the auditor, when the auditor comes to audit financial statement, they are particular, especially for companies that are PLCs. The auditor tends to focus more on what? Directors and emolument. It's very, very small. It's one of the smallest amounts in the financial statement. What is very, very essential that we're able to understand how the directors' emolument or remuneration is computed. Okay, it's very essential that they are what? They are computed appropriately. Okay, that's another factor. The other factor is the impact of an item on the view presented by the what? The financial statement. Okay, and that has to do with what? A reporting profit is converted into a reporting loss. All right. So that is that about materiality. Is that clear? So we have looked at audit plan, we look at audit planning memorandum, we have looked at audit risk, and we just finished looking at what? Materiality. Does anybody have any question before we proceed? Any question? Any comments? Any observation? Go to the next one, which is the last one. It's called computer and auditing. Computer and auditing, we are going to look at two aspects. We're going to look at the CAT, computer assisted audit techniques. We're going to look at COBIT, okay? Control objective for business related information technology, COBIT, okay? What do we mean by computer in audit? So what that means is that for you to utilize this computer in audit, this is the CAT and the COBIT, right? Your client's environment must have been computerized, that is the makings of what? Computer systems. When your client does not have a computer system, this approach might not be practicable. Okay? So when the client environment is set up in this format, then the auditor might use computer to perform audit work. So it will do less of what? Manual work. Number two, there exists an accounting system, either an accounting package or an ERP. Okay, using computers to perform the work. Now, when the auditor is using the computer to perform his work, what happens is that audit administration and control is done via the what? The computer system. So they're able to carry out the audits using what? Computer system, because the ERP and the accounting packages are on computer system. And the auditor can easily administer the audit from that area. It can also carry out the audit virtually or remotely. You need not to be present at the client office. You can do it virtually because of what? Because there exists a computer-based environment. Okay. Number two, audit work and audit planning will be done on the system. So you're not going to go about the audit working paper in physical form, in paper form. They are already on the what? Embedded on the what? On the system. Okay? To be able to do all of that on the system. Number three, you're able to use computer to prepare this audit working paper. Okay? I believe you have talked about audit working paper in chapter 8 under audit evidence, audit documentation. Okay. Then you're able to carry out analytical review procedures by using what we call ratios. On Excel, there are ratios there. Okay. You can use Excel to compute your ratios. Okay. You can use your Excel to carry out your ratios. And there are some other software also that have been designed to perform some statistical and financial ratios. Okay, they have been designed, the format is there. All for you need to just to plug in the parameters and the ratios will be what? Will be computed. All right. Then the sampling, all the sampling software can also be utilized. Okay, because of carrying out the sampling, trying to test which data, which ledger you want to test to evaluate for material misstatements. There are some other softwares that you can deploy them and you to recognize or to conduct the audit sampling for the auditor. The auditor will be able to check those transactions that are what? That are susceptible towards manipulation, or there are transactions that you don't need to pay so much attention on. Okay? So that's that. The next one, control over the audit computer system. Now, when the audit work is performed largely on computers, the auditor may have suitable controls in place. Essentially, there are some controls that could apply in any computer applications. What are some of those controls? Now, client data remain confidential and cannot be accessed by an authorized person because you have deployed what we call password or you use encryption. Okay, so nobody can have access to the information unless you give the permission to do so. Okay, audit work held on computer file cannot be lost. Once you have backed it up or you have stored in the cloud, it can be retrieved at any time. Number three, audit trail is created for work of the auditor that is done on the what on the computer. What is audit trail? Audit trail has to do with how do I put it? Traces. I don't want to use the word trail. Um, evidence of activities performed, okay, on the computer system that can be linked to the initiator of such process or activity. We call it audit trail, okay? Another name you can call it is what we call a digital breadcrumbs. Okay, what do you mean by digital breadcrumbs? Now, remember, if you eat bread, especially sliced bread, there's no you're going to eat sliced bread that is not going, you not see crumbs on it, okay? Those crumbs that fall out of the sliced bread. Now, until you pack or you sweep that area, somebody will know that you ate bread in this area. You are going to leave what? Crumbs. Crumbs is what? Evidence. So, I mean, audit trail is what? Evidence that something has been done by another person. And there's no how you can wipe up audit trail in any transaction that is done on the computer. You cannot hide it. There are ways to track it. There are ways to check it. Okay? So that's what we call audit trail. And that can only be done when you have done it on the what on the system. That's why you say that kidnappers, when they want to demand for ransom payment, they tell you that go and withdraw cash. Because if you wire the money to them electronically, the police, EFCC, and DSS can trace that person. Okay, they can trace that person to whoever received the money. Can easily be traced. That's why you see, I always request for what physical cash. Okay, that is the reason because of this audit trail. Okay, there's also what we need to call we call general controls and application controls. There's a difference between both of them. Okay, what are general controls? General controls are controls over the environment in which the computer-based information is designed, developed, operated, and maintained. For instance, when you put your laptop in an office and you lock the door, that is a general control. You have locked the door. You put your laptop on the table so that should there be flood, the laptop will not get soaked in water. That's the general control. Okay? That's a type of what? A general control. That is control that are designed over the environment in which computer information system is what is kept. Is called general control. Okay, anything that you do, for instance, you put your laptop in an office, you put it under your drawer, or put it in your safe, wherever you put it. Whatever you do at that point in time is called what? General controls. Okay. Then we have application controls. Okay. Application controls are controls that are peculiar to each application on the computer system. They are controls that are peculiar to each application on the what? On the computer system. We call it application controls. Okay. So for instance, on your system, you have the payroll system, you have your ERP, you have the accounting package, your Sage, okay, you have your Microsoft Office. All these are your applications. There is a need for you to put some controls around these your applications, okay? We call it application controls. Hope you understand. All these are application controls, all right? So I think that is clear. All these are application control. So you know the difference between the two. Application control and general control. This is clear, okay? Let's go to the next one. COBIT. COBIT is control objective for information and related technology. Okay, that is COBIT. Okay, this one you cannot see it with your naked eye. Okay, you cannot see it in your watch with your naked eye. It happens at the back end. The essence of this is to ensure there is what? There is protection or security of your watch, of your information. Okay, to ensure there is control or protection of your what? Information. All right, that is the essence of COVID. To make it difficult for somebody, for hackers to sniff or to take away your information on the what? On the network or on the system. Okay, we call it COVID. What are the purpose of COVID? Now, COVID provides management and business process owners with an information technology governance model that helps in understanding and managing the risks associated with what? Audit, risks associated with what? IT. There are some risks associated with IT. Remember in chapter 16, applications of IT in an audit environment, we have dealt with this one extensively, okay? So you look at that. So it's a control model to meet the needs of IT governance meet the needs of IT governance and ensure integrity of information on the system. You know that your information has three elements or characteristics: confidentiality, integrity, and availability. Right? So information should be available at all times. That's availability. Information should not be compromised. That is integrity. Confidentiality is that your information should be what? Should be kept away from somebody that can hack it. Okay, that's confidentiality. So at all times, these are the three main essentials of what? Information. Okay. Okay, so those are the things you need to know about COVID. So COVID is a business process oriented and therefore address itself in the first place to the owners of the processes. Generic business model refers to core processes such as procurement, operations, marketing, sales, as well as support processes. Okay, human resource, that support processes are what? Human resource, administration, information technology, all of these are part of support processes. As a consequence, OBIT is not applicable only by the IT department, but also the business as a whole. So whatever we are doing is that when you're talking about OBIT, you must ensure that your IT objective aligns with your what? Your business objective. There's something like IT objective is standing on its own. There should be a connection between your IT objective and your business objective is very, very important. Okay. So your COBIT has the following component. Number one, management guidelines. Management guidelines. Number two, executive summary. Number three, framework. Number four, control objective. Number five, audit guidelines. Now, what do we mean by this? Management guidelines means that how is it going to be put in place such that it makes it easier for the management to understand and be able to measure if this objective is achieving is goal. That's if the IT objective is meeting up with the business objective. That is management guidelines. Executive summary is a report that the COBIT is ready to generate from time to time that gives like an overview of how the objective is being managed or addressed. We call it executive summary. Framework. Framework is the structure put in place as a result of the what? The COBIT, the IT governance structure. Okay? That's put in place to ensure that security of information. Control objective. The management will set out what they intend to achieve when they put in place this COBIT, what they want this COBIT to achieve, and they will ensure that this COBIT achieve this. One of it is that there should be no um, theft or hacking of information. Or if such happens, not all the information will be hacked. Like what happened some weeks back with GT Bank, GTCO, when some of their customers could not access their internet banking, and there was a rumor that the site has been hacked until when they came out with a publication and debunked that rumor. You understand? We call it control objectives. Okay. They have the audit guidelines. Audit guidelines is to ensure that there is a system or there is a structure put in place to track that these COBIT, this IT governance framework, is actually working as planned. Okay, there's need to be what? Assessment. There needs to be what? Monitoring by the audit team to be sure that this COBIT is achieving the what? The objective. Then you have the implementation tool set. Implementation tool sets are the reports, okay, the programs that have been put in place to track and ensure that the objectives, both the IT objective and business objectives, are being achieved. Okay, those are the components of the COBIT. All right. Then we have the computer assisted audit techniques. We call it CAT. What are CAT? CAT are defined as any technique that enables the auditor to use computer system as a source of what? Generating audit evidence. You use CAT as a source of what? Generating what? Audit evidence. Rather than for you to use your manual system, you use CAT to generate audit evidence. Okay, we call it CAT. And there are two types of CAT. We have the audit software and you have the test data. There are two types of CAT. We have the audit software and you have the what? Test data. What are the software? Audit softwares are computer programs used by the auditor to extract information from the client computer system. Okay, you install it on the client system, you're able to extract information online real time. We call it what? Audit software. All right. Essentially, you use audit software when you want to carry out what we call test of detailed transaction. Essentially, you use audit software when you want to carry out what? Test of detailed transaction. Okay. Then you have your test data. Now, before I go to your test data, there are three types of audit software. We have the interrogation programs, which are programs that are designed to access the client files and records and extract data for auditing. Okay, there are programs that are designed to access client files and records and extract data for what? For auditing. Interactive software. These are used for interrogation of online computer systems. For instance, you log on to Slot website now on the internet. Something pops up and asks you, how can I be of help to you? That bot that chats you up is an example of what we call interactive software, but it's trying to obtain information or how it can be of better assistance to you. Okay. The last one is called resident code. Resident code or embedded software are installed on the client system to monitor and review transactions as they are being processed on the client system. Okay. So they are installed. So once they are installed, it's like a tracker that can see what is happening or what is being done at the client premises. Okay. Those are the examples, those are the types of audit software. Let's look at the next one. Test data. Test data, unlike the audit software that is used for test of detailed transaction, test data is mainly used for what? Test of controls. You want to use to test whether the internal control system is what is working. So what does it do? It's it is employed such that you would have you would have your predetermined result with you. Okay, you now use this your test data to confirm whether your predetermined result is correct. Okay, let me give an instance. You look at your, what do you call, your inventory. You have done your physical inventory and you have your physical inventory balance. You want to be sure that your inventory balance is correct on the system. What do? You now use your ERP or your accounting package, okay, to now, based on the receipts, the issues, the issuances, okay, of your stock within a period. You now use your ERP to calculate what is your closing balance. Normally you have your what physical balance that you have already, which is correct. You want to be sure that your system is also correct. So you now use your system to do the conversion and the calculation. When you arrive at the same value or the same balance, then that shows that your test data is what is okay. But there are instances where it will not give you the same value or the same result. When it does not give you the same result, you need to investigate the reason why there are variances. Okay. When you carry out those variances, it's also a way to check that your internal control system is not effective as you thought. There are still some deficiencies within your internal control system. Okay. And that is what we mean by what? Test data. You can see you can only use test data one by one. You can use it on a particular transaction. You cannot use test data on everything. You have to be specific. Unlike in the case of the audit software, you can use it on everything. It's not limited. Okay? But test data is limited. It's peculiar to a particular transaction or a particular objective. That's the difference between the two. Okay? So let's look at some of the problems or the let's look at some of the advantages of CAT and disadvantages. Number one, advantage of CAT is that it gives the auditor an ability to test the completeness and accuracy of an electronic processing itself. That is, with the use of CAT, the auditor can understand the input, the processing, and the output of all transactions in the client system. Not going to focusing on only the input and the output. They can also understudy what happens at the processing section of the client system. Number two, use the auditor the ability to test a large number of transactions because you are using system. You can test large volume of what transactions. Number three, it allows the auditor to test the effectiveness of controls that are programmed into the computer software. So the auditor can test. By the time he carries out what we call pre-performance, okay? Pre-performance. By the time you carry out pre-performance for some of those things, you say you have this control, the auditor will initiate the transaction and check whether there are gaps in those transactions or those processes or not. Disadvantages of CAT, as good as CAT is, it has its own disadvantage. What are the disadvantages? Number one, it's very, very expensive to buy. Okay, because it's not that it's expensive like that, but then you convert the foreign exchange or foreign currency to naira, it will be very, very high. Sometimes the prices in the foreign currencies are the same, but the conversion to naira that makes it to be what expensive. Number two, there are updates that need to be run on this cart, just like your computer, just like your phone. If you don't run those updates, it will not be effective. Number three, you need to train staff on how to use this cart. And sometimes this training can be what? Expensive, okay? Number four, sometimes the clients are reluctant to installing this cart on their system. You don't want to have a tracker on their system. So there's that difficulty in obtaining what? Um, Permission or approval for the installation of these cards on their what? On their system. Okay. So with this, we are done with chapter 7, which is planning. Does anybody have any question, comment, observation? Please, let's ask questions now. Are there questions, comment, observation?
So what I have is not a question, right? So I just wanted to say that these cards and the bits that we just did now, I wanted to know if that's chapter 16, the application of IT in auditing, because that topic is still
No,
outstanding. Okay, and
no, it's
also
chapter 7.
okay, also professional responsibility and liability. I wanted to know if we are still
Yes.
going to have the class.
You want us to have the class? No problem. Can we do it next? The last time I asked this question over the week, nobody responded until yesterday when you people suggest that we do it on Saturday. Would you still be open for Saturday, next week Saturday? Or we can do it
Okay,
during
fine.
the week? Can we do it on during the week? Hello?
Monday
Please
to
honestly
Friday
respond
is
now.
occupied, so you can take your slot on Saturday
On
if
Saturday.
that is
Okay,
okay.
fine. No problem. That's fine.
All right, thank
That's
you.
fine by me. All right. Then further, is there any other question? Any comment? So we are fine. Thank you so much for your time. So enjoy the rest of the weekend. Thank you.
No, there was something you said you were going to send to us. I think a tape
Which one is that?
recording audit evidence.
I did. Did you receive it?
Maybe I missed
Please
it.
check.
I said my colleagues got it. I don't think I saw
Please
it.
check. If it's not there, just remind me. I will send it again today. I did. I sent it that same day I sent it. Unless maybe the thing did not deliver.
Did
I'll
anybody
check,
get
but
it, please?
please check. Please check. If you have not gotten it, just send the notification on the platform. I'll do it again. That's not an issue. All right. Any other question? Are we good? All right. Thank you so much for your time. Enjoy the rest of the weekend.